What's up, YouTube? My name is Andrew, and today I want to discuss what assignment, exercising, and expiration all mean when dealing with option contracts. Now, if you didn't see my last video of a beginner's guide to what option contracts are, please check that out, and I'll link it somewhere in this video. But a quick overview of what an option contract is a option contract gives the purchaser the option, but not the obligation, to either buy or sell 100 shares of underlying stock for the option. So exercising a option contract is basically like taking the action that is specified in the option contract. So for calls, that action is buying. For puts, that action is selling the underlying stock. And for YouTube videos, it's hitting that like button. I'm sorry, I had to do it, but please do hit that like button. It helps me out grow my channel. But as far as assignments are when that action happens to you. So if I sold a call, then I am selling my stock. And if I sold a put, then I am purchasing those 100 shares of those 100 shares of stock. Now, expiration is when the contract expires. So when you buy a contract, there's a specified date. So normally it's a Friday of the market, unless it's around a holiday, and that's when the contract expires. So let's say if I bought a contract that expires at the end of this week, so February 19th, 2021 is when our contract is going to expire. That's when expires in the money, it will get exercised, and if it gets expired out of the money, it will expire worthless. All contracts expire worthless unless they are in the money. Now, if you missed out on last week's video, please check that out. That explains what in the money and out of the money are. But out of the money is when there's some value left in the contract. Let's get into what I have prepared on screen, which is a candle chart for Snapchat. And just kind of want to run through a few scenarios of what to expect. So let's say I bought a call option at $64 that expires this Friday, February 19th. So at the point of when Snapchat was above $64, I could exercise that stock and buy those 100 shares at that price if I wanted to. If I held until expiration, and let's say it was $64 and $64.50, Robinhood would automatically exercise my option because I'm technically in the money. Now, if it was $69.50, I'm out of the money and that call option expired worthless. So the premium that I paid for that call option is useless. It's gone. Now, let's say I sold that call option and I was hoping, I sold that call option, I retained the premium, and I was waiting to see what the person that I sold it to made a decision. If I was assigned early, which means I have to sell my shares now, I get told that I sold my shares, I retained the $64 per share for the stock, and somebody else takes my shares away from me. Now, that's normally people only exercise options if they're in the money, but sometimes people do it at any point in time. It's just they have the option, they have the contract. So normally at expiration, if I sold it and it's, let's say, $65 now, my shares would be called away from me and I would only be able to get $64 because I sold at $64 call strike price. Now, if it was $63, I get to keep my shares and the premium that I had for the given call option. So that was the buying and selling a call. Now, let's talk about buying a put. So let's say I bought a put of $64 when it was at, let's say, $65. So I bought the $64 put and I plan on holding it because I think the stock is going to go down for this week. So I waited until it reached the $62 and I decide to execute that put option. So that means I'm going to sell my shares because I don't want in this position anymore. I'm going to sell it. It's $62 a share. I'm losing money right now. I need to sell it to somebody else. And I already have that contract to sell it at $64. So I sell it at $64 a share. I retain $64 per share, so $6,400 because it's 100 shares. And the person that bought that contract has to buy it. Or the person that sold that contract has to buy my shares at that price, no matter what the share price is at this point. So they're now taking that $200 loss. Now, if let's say I bought the $64 put and it doesn't go below $64. So let's say it stays here. Let's say instead of going down here, it went up to 65 and it stayed above 65. My call or my put is now worthless. And I lose all the money that I spent buying that put option. So let's say I I sold that $64 put and it drops down to $62 and somebody assigns it early on me and before expiration. I am now the person that has to buy the $64 or buy the shares at $64 a pop and hold the bag essentially. I sold the contract. I have to take my licks at that point. Whereas if it expires, if that person doesn't and they hold till expiration and it is below the $64, it gets executed because it's in the money and I still have to buy them at $64 a share. Or let's say it rebounds and goes above the $64, let's say $64.20. I now don't have to pay for those shares and I get to keep my premium because I sold the put option. So I hope these 4 quick examples helped out your understanding of what getting assigned, expiration, and exercising call options, put options are. There's more intricacies on more advanced option contracts, but I'll cover those when I cover those topics. If you like this video, please hit that subscribe button and that like button. It really helps my channel out. And please let me know if you have any more questions about exercising, assignment, and expiration around call options down in the comment section below. Thank you. I hope this helped.